Episode 18. 18 is the year we are finally allowed to vote. 18 is the year I started undergrad at Queen's University. Emma Raducanu is an 18-year-old who won the women's final at the US Open for tennis. Jack Nicklaus has 18 major championships, and the greatest athlete to wear the number 18 is Peyton Manning. Beyond MD, episode 18, here we go! Hey guys, welcome back. Episode 18, Beyond MD. Thank you again for joining. Now, I will give a word of warning. Today's episode is a little bit more complicated than average, but it's not too bad once you break it down. And I have to say, these topics are among my favorite to explore because they are relatively under-discussed, and it's fun to kind of pick them apart to see if they do offer a benefit. So thank you to one individual in my network, that is Marc-Antoine Blondin, who is a CFA out of Montreal. And he did message me in April asking me, had I heard of this? And if not, encouraged me to learn about it. And then funny enough, since he messaged, 3 people asked me if I would be covering this topic on the podcast. So here we are, the Retirement Compensation Arrangement, the RCA. So this is a tax-deferred, non-registered retirement savings plan. And to be eligible, there has to be an employer-employee relationship. So for us, that means we have to be incorporated and you have to be paying yourself salary. So the corporation is going to put money into the RCA, and those funds are a full tax deduction to the corporation. So once money gets into the RCA, half of it is going to flow into an investment account, which we will call the IA. The other half of the money that's put into the RCA will actually flow into a refundable tax account, which is held by the CRA. We will refer to this as the RTA, and this is a non-interest bearing account. So the investment account and the refundable tax account, these two accounts at year end essentially have to be in balance. So what does that mean? So let's say in the investment account, you're obviously investing the money, and if you have realized capital gains, interest and dividends, well, half of that is going to flow into the refundable tax account. On the other hand, if you have an investment loss inside the investment account, then half of that loss is going to have to flow out of the refundable tax account into the investment account to make sure that these accounts are in balance. So in retirement, what happens? Well, the participant is going to pull money out of the RCA, and that money comes out of the investment account only. And the money that you take out, you're going to be taxed at your marginal rate, which you hope will be lower. So money flows out of the investment account, and half of the money that is taken out then is going to flow out of the refundable tax account into the investment account again to make sure that those two accounts are the same. Are you confused yet? That's okay. We're going to go over this again one more time. Now, why do people consider an RCA? Well, simply put, some people want to maintain a certain standard of living in retirement, and there are options, obviously, RRSPs, pension plans. So with the individual pension plan, you can make sizable contributions to it, but the salary that you can pay out to yourself in retirement is unfortunately capped, and the ceiling currently is just over $160,000. The RCA allows you to go past that. It allows you to replace more of your pre-retirement income. So to help us understand the RCA, we have Sophie Cournoyer, and Sophie is an actuary at Vias, which is a consulting firm located in Brossard, Quebec. Sophie has more than 30 years of pension experience acquired mainly from Canadian and US actuarial firms. She is a fellow of the Canadian Institute of Actuaries and the Society of Actuaries, and she also holds a Master of Business Administration and a CFA. Now, all conflicts of interest have to be acknowledged, and Sophie and her firm, they do sell IPPs and they do sell RCAs, but as you will see in this conversation, nobody is trying to sell this product. We are simply trying to educate because it is complex. It is not well understood by many, so I'm excited for it, and with that, here's my interview with Sophie Cournoyer. All right, Sophie, welcome to the podcast. Where does the podcast find you today?
I am at work, actually, in the office. This is how it works at Vias. We prefer to be all together.
Sophie, thank you for joining me today to talk about the RCA, the Retirement Compensation Arrangement. I know it can be a somewhat complicated topic, so I appreciate you being here. So I'll start by just asking you, what is an RCA and who is eligible and who can benefit from an RCA?
The RCA is, as you mentioned, a retirement compensation arrangement. The objective of the RCA is to provide the benefits upon retirement, death, or termination of employment. And actually, RCA is a non-registered retirement savings plan, and it must be sponsored by a company. So it has to be set up by a corporation. And it allows for payments of benefit in excess of those payable under a registered pension plan, such as an individual pension plan. And here at VIAS, we use the RCA to supersize the IPP for business owners and incorporated professionals earning salary in excess of the IPP salary limit, because there is a salary limit on the IPP pension formula, and the salary limit for the year 2021 is $162,000. So if there is an incorporated professional or more than that, he will be hit by that limit, and he won't be able to get, let's say, an adequate retirement pension benefit because of that limit. Just for illustration, for an IPP, in the IPP, the pension formula is 2% of salary for each year of service. So let's say you have a professional, incorporated professional, who have a salary of $500,000 and will have, let's say, 30 years of service at his or her retirement. So it means based on the IPP formula, he should get a replacement ratio of 60% of his salary at retirement for his annual pension. But because of the salary limit under the IPP, he will only get about 20% of his salary at retirement. So the missing 40% to get adequate retirement, so for him or her to maintain her, let's say, standard of living. So the RCA will provide that gap, that missing 40%. So you should view the IPP as the base plan, and the RCA will be on top of the IPP and will provide supplemental pension benefits, so the gap of that 40% that I mentioned before. So that way, that incorporated profession will get more adequate benefits.
Perfect. So my understanding is if somebody wants to enroll in an RCA, typically they have to be incorporated and they have to be paying themselves salary, right, to be eligible for this as well?
This is correct, yeah.
Perfect. And so just to kind of summarize what you said there, your firm will establish IPPs first, and then if needed, they will layer an RCA on top of that. And the reason you just described there is, let's say if you are a professional, you are contributing to an IPP for 20 plus years, even if you have a very large salary and you made large contributions, you're saying the IPP has a ceiling and you'll never be able to kind of go past that ceiling in terms of your salary, right?
Yes, you're right. And also because that salary limit does not apply for RCA, it means there could be more contribution room under RCA than under an IPP. And as you know, because of the new the tax reform, and because of that, the new fiscal rules with respect to the small business limit, the passive income. So it means because of the salary limit, there's a ceiling on contribution that you can make to an IPP. There's a kind of ceiling also for the RCA, but it's higher. So that means for a business owner or an incorporated profession who has some difficulties in meeting the passive income rules, and he is a high income person, so it could put in place an RCA to be able to contribute more than it would be with only an IPP.
So now that we're talking about RCAs and IPPs, maybe you can just summarize for us the main differences between an RCA and an IPP.
I would say the main difference is that under an RCA, there are less legislative requirements. And so because of that flexibility, So under RCA, there will be more flexibility in the determination of contributions and pension payment. So, for example, RCA has no age limit for the commencement of benefits.
Okay.
And in an IPP, the pension payment must commence at the latest by age 71.
Okay.
So that means if you have an IPP, your pension must start at age 71. But under an RCA, you could decide to postpone it after the age of 71. And also under RCA, there is more flexibility in the payment option. If you decide to pay you a pension with an IPP, it has to be a lifetime pension. So you have to receive the pension for your life.
Gotcha.
Under an RCA, you may have the option at your retirement to decide to pay the value of your pension at retirement over a certain number of years, let's say 10 years. So not for a lifetime, but a number of years. And also, there is no funding requirements under an RCA. There is only one important rule for the RCA with respect to the calculation of the RCA maximum contribution. It's the reasonable test. So the RCA contribution must fund reasonable pension benefits. So what does it mean, reasonable pension benefits?
Yeah.
Usually it's the same pension that you can get from a registered pension plan, such as IPP. So it means the RCA will pay you, let's say, like I mentioned before, the 2% per year of salary, but without applying the salary limit. So, and also another interesting thing is that because there is no funding requirement, there is no requirement for the frequency of actuarial valuation.
Gotcha.
With an IPP, the IPP must be valued every 3 to 4 years.
Okay.
But for RCA, there is no such requirement. That means that to set up the RCA, you need an initial valuation to determine the contribution.
Yep.
But after that initial valuation, there are no requirements to perform a subsequent valuation. So you may decide that you do your valuation. You may decide to finance your RCA with the one lump sum contribution, and that's it. And that will be it for the financing of that pension promise under the RCA.
It sounds like it's a very flexible arrangement. And you mentioned that if one has an RCA, then they don't necessarily have to start pulling money out of it by age 71. You said you can postpone it. What about if somebody wants to start earlier? Is there any age that is too early, or you can start to pull money out of the RCA at any time?
The RCA will pay the benefits in accordance with the RCA agreement. Okay? And because we say that it must provide for a reasonable pension, so usually they will copy what you can find on the registered pension plan. So, but with more flexibility, but because there are no requirements. So you will be able to pay an early retirement, maybe before age 55 if you wish.
Okay.
That will depend on the RCA agreement that will be decided at the time of the RCA setup.
Now I have just a few really basic questions on some of the basic features of an RCA that I want everybody to understand. And I'll kind of just maybe ask you these one by one. They're probably really quick answers too. So in terms of the governing body for the RCA, is it the CRA is the governing body for it?
Yes, the Canada Revenue Agency. And the only legislation is the Income Tax Act.
And what about funds that are in the RCA? Does it offer creditor protection?
Yes, it is a trust. So the assets are completely separate from the assets of the company. So because of that, you get your assets in the RCA are protected from the company's creditors.
Perfect. And the professional corporation would be contributing to the RCA. And so the money that is contributed by the corporation, I'm assuming that is a tax deduction to the corporation?
It's fully tax deductible, so 100% tax deductible by the company.
And we're going to talk about this in a second, but the RCA has two components, an investment account and a refundable tax account. And we can refer to these accounts as the IA and the RTA. in the investment account, if you're just buying and holding and not realizing any gains, will it grow tax deferred in that investment account? Yeah.
Yeah, it's tax deferred. It is a very, very important. This is a refundable tax account, but money that is held in the RA or in the RTA are not taxed while they remain in those two accounts.
And then there is the ability to buy back past service, right? Like, let's say if I start an RCA later in my life, but I've been incorporated for many years, you can buy back past service?
Yes, past service with meaning the service that you have accrued with the company prior the setup of the RCA. Yes, and you have even more flexibility because it will be easier to buy back service prior to January 1st, 1991. For the IPP, it's more difficult.
Now, we know that contributions to a typical pension plan, it can affect our RRSP contributions, but does the same apply to the RCA? Like, does this affect our RRSP contribution room?
It doesn't affect because this is a non-registered pension plan, so there is no what we call the pension adjustment, which is used to reduce the RRSP contribution room.
Mm-hmm.
So there is no PA because the RCA is a non-registered, so it will not have any impact on the RSP contribution. But if you set up the IPP, for sure, you will still have an impact because you have the IPP.
And now let's say I'm getting ready to retire. I want to pull out money from the RCA. How does income splitting work? Can I split it with my spouse or not?
It depends. If you have an IPP as the base plan, you won't be able because you will reach the pension splitting limit with the IPP. So there will be no room left for more income split.
Okay, but then the RCA, like let's say if one just had an RCA, I know at your firm you don't do that, but does an RCA also allow for any income splitting or not so much?
Yes, you will be able to do income splitting, but it will be up to the limit of a registered pension plan.
Perfect. So Sophie, now let's maybe just dive into the RCA trust. I know you already talked about the two types of accounts, the investment account and the refundable tax account, but I would just like you to teach us a little bit about the structure. Tell us what we need to know about those two accounts.
Under the RCA, there are two accounts. The investment account, as you mentioned, this is the same account as the IPP. And the RTA is the refundable tax account, is a non-interest bearing account. And it is administered by the CRA, the Canada Revenue Agency. So no investment are held within the RTA. And because there are no investment in the RTA, so there is no investment income. So the only investment income that you can get is under the investment account. Okay. So when the company contributes to the RCA, 50% of the contribution is deposited into the investment account, and the other 50%, in the refundable tax account. And the investment account, this is where you invest your money, but it's 50% of the contribution. But there's a kind of a required balancing between the two accounts, because at every year end, they must be equal.
Okay, maybe you can talk to us a bit more about the mechanics of the RCA. So what I'd like to know is, how are payments made from the RCA to the participant of the plan? And then with respect to the two accounts, the investment account, the IA, and the refundable tax account, the RTA, maybe you can talk to us about how those two accounts need to stay at the same level, how they need to stay balanced.
So it means when the RCA makes payment to the participant through the investment account, because it will be always investment account who will pay the benefits to the participant.
So in retirement, payments to the individual or the participant are only received from the investment account, not the RTA, right?
Yes.
Okay, and then these payments to the individual in retirement, they're going to be taxed at the individual's marginal rate, right?
Yes. So at that time, at year end, there is a balancing because, the full payment was paid by the investment account. It means, to balance at the end of the year, it means 50% of the payments made during the year will be returned from the RTA, the refundable tax account, to the investment account to balance out the two accounts. And also, at the end of the year, if there is an investment income, if an interest or dividends or realized gain were earned by the investment account, 50% of that investment account will have to be transferred to the refundable tax account because there is more money in investment account to balance out the two accounts. So this is the way it works. And with respect to the investment account, this is the account where you have investment in. It's very, the eligible investment are very wide. You can invest in equities, mutual funds, fixed income. So it's, but the only not permitted investment would be if you cannot invest, the investment account cannot have a debt of the participant, cannot make a loan to the participant, and investment in which the participant has a significant interest. So the investment account cannot invest in a stock, let's say, where the participant owns 10% or more of the company. But, these rules also apply to the IPP. And this is why we mentioned, I think, earlier that a buy and hold strategy may make sense for RCA, because that way you will get only unrealized gain, and that gain doesn't have to be transferred to the RTA. So you will reduce that effect of the RTA.
Sophie, I want to just take one step back. I just want to make sure people understand the basics. So let's say next year, I'm contributing to an RCA, and let's say I'm going to contribute, just to keep numbers simple, $50,000. So can you just tell us, like, that $50,000, how that gets diverted into the investment account and the refundable tax account? Like it's $25,000 in one and $25,000 in another, right?
Yes. 25,000 in the other, yes.
Yeah.
So that means if we go 1 year forward,
yep,
you may have earned an income on that 25,000 that will be deposited in the investment account.
Yep.
Let's say you have earned 5,000.
Yep.
So that means you have 30,000 at the end of the year,
yes,
and 25,000 in the other account. So to net out the two accounts, you have to transfer 2,500 from the investment account to the RTA account.
Makes sense.
And it works also for the opposite situation. Let's say you have an investment loss, because it could happen that you have lost, that you may have a loss in investment income. So if, let's say, you had that 25,000 at the beginning of the year, but you have a loss of investment loss of 5,000. It means 20,000 at the end of the year, and you still have that 25,000 in the RTA at the end of the year.
Yeah.
That means 2,500 will be transferred from the RTA to the IA.
Okay, perfect. So basically, that illustrates what you were saying before, that the investment account and the refundable tax account at the end of the year, they have to be in balance. So I guess, let's say I'm getting interest payments as a source of investment income into that investment account. Let's say those interest payments for the year are $10,000. So then I've gone from 25,000 to 35,000. So then 5,000 has to move into the refundable tax account to make them equal, right?
Interest income for sure, because they are realized income.
Perfect. And then on the other hand, let's just to make sure we hammer these points home, let's say I invest in a stock, and then let's say that the price of that stock falls in 1 year, and if I realize that loss, let's say it's a loss of $10,000. So then the realized loss will bring the investment account down by 10,000. So then you're saying 5,000 will have to move from the refundable tax account to the investment account to keep them equal again.
Yeah, this is correct.
Okay, perfect. Okay, so now I am better understanding this, and so I guess, when you make a deposit into the RCA, so half goes into the investment account, half goes into the refundable tax account. So the refundable tax account, that's basically money that's given to the CRA. It's not earning any interest. Is that why people may say that the RCA can be, in one way, a little bit inefficient compared to an IPP because half the money is not generating any returns? Is that safe to say?
That's correct, because that means you earn interest only on half of your assets. But you have to keep in mind that it is not tax. Assets under both the accounts, the RTA and the RTA, are not taxed until payments are made to the participant. And when they are taxed, it is at the tax rate of the participant. So let's say you have a participant who plan to retire in a low tax jurisdiction, or when he will retire, he will be in a low tax bracket. So it may mean for him significant tax savings. So,
Sophie, that is really interesting. I don't want to get into too many details because I know it can be complicated, but what you're saying is if you retire in a lower tax jurisdiction, and I guess that could be another province, but that could also be another country, right? As long as there's a treaty with Canada. Is that true?
Yes.
So theoretically, you could open an RCA in Canada, and if you're retiring somewhere else where the tax rates are lower, then the RCA can allow you to save on tax in your retirement, then essentially, right?
This is correct. Also, not to forget that the RCA was financed by 100% tax deductible company contributions.
Okay, so I can see where some of the tax efficiencies can come into play there. Now, Sophie, obviously for many people, the new passive income rules have had an impact. So if you have too much investment income in your corporation, then that can have implications. So can the RCA be useful in this context as well? Like, let's say if somebody, to kind of work around those passive income rules, can you in a given year then just kind of make an excess contribution or make a contribution to the RCA to kind of work around these rules? Is that possible too?
Yes, for sure. And it can be used the same way as for IPP with respect to passive income. But as mentioned before, the RCA will have larger contribution room than the IPP because, there is no salary limit. So that means higher pension. And to finance it means higher contributions. And also you have to keep in mind that because only half of the RCA assets earn interest, that means that when the actuary will calculate the required contribution, he will take this into consideration. That means the expected long-term rate return for the RCA assets are about half of the IPP. So that means it will require much more contribution to finance the same promise.
Got it. Okay, that is starting to make more sense to me. You reminded me of one thing, Sophie, that I forgot to ask you. So our understanding is that the investments inside an individual pension plan, if they generate too much return, then it can essentially affect the amount that you can contribute in a future year. Does the same apply to the RCA? Like, let's say the RCA investment account is returning 20% per year for a few years. Let's say the time investment returns are very good. Does that affect the amount that I can contribute in a future year?
But I would say it's not an issue for RCA because, as mentioned before, when you say you have a surplus, it's because that surplus was determined by an actuarial valuation.
Got it.
And there is no requirement for valuation under RCA except for the initial one. But you may decide to do only the initial valuation, and after that, you may decide not to do other valuation with respect to the funding. I would say it's not an issue because the IPP must be valued every 3 to 4 years. So that means it will happen that maybe the IPP may be in a surplus position, but for the RCA, you have more flexibility in deciding when you will do a valuation.
One thing, Sophie, that is on our minds is how to efficiently transfer money, assets to the next generation. I'm wondering, is this at all possible with an RCA? Like maybe we can just briefly talk about two scenarios. Let's say the kids are part of the family business, and then in another scenario where the kids are not part of the family business. Like, is it possible to set up a tax-efficient intergenerational wealth transfer with an RCA?
I think it will be done the same way as it could be done for an IPP. Family members will participate in the RCA, but to participate in the RCA, they must receive a salary from the sponsoring company. And that means that the RCA assets could be used to fund all the pension for all the family members. It's about the same approach that is used for an IPP.
And then just briefly, let's say when somebody passes away, what happens to the RCA? Does it then just kind of roll over to the spouse on a tax-deferred basis?
I would say in most cases, but it will depend on the RCA agreement.
Gotcha.
But you have to keep in mind that when there is a payments made by the RCA, it will be taxed when it is received.
Now, Sophie, can you tell us a bit about the costs of an RCA? Like how much does it cost to set it up? How much does it cost to maintain it?
Okay, for the setup, I would say approximately 5,000 plus taxes.
Mm-hmm.
And after that, for ongoing administration, if the ongoing administration is limited to the annual filing,
mm-hmm.
would be very minimal, maybe not more than 1,000 plus taxes.
Mm-hmm.
And if the company decide to produce subsequent valuation, mm-hmm. so it is at the complete discretion of the company.
Mm-hmm.
For valuation, it may cost $2,000 plus taxes.
Let's say I contribute to an RCA this year, but then I don't contribute for another 5 years. In that 5 years, when I'm not actually contributing, am I still paying kind of the annual filing fee of $1,000 per year?
Yes, because the filing is required even if there have been no activities in the RCA.
Perfect.
It has to be. You have to file on an annual.
Got it. But I think one important distinction from the IPP that you mentioned is usually for an IPP, every 3 years or so, there's kind of an actuarial kind of calculation. So there'd be a fee there. But for the RCA, you said it does not have to be every 3 years. It's kind of more at one's discretion, right?
Yeah, it depends. It depends on how the company wants to finance the pension promise under the RCA.
Okay.
So it depends on the objective at first. Why have you decided to put in place that RCA?
Got it.
If you decide to do only one valuation,
yep,
and that money will you may decide to make one-time contribution, and that money will be invested in the investment account, and you will get the other half in the RTA account. And at the time when there will be payments made to the participant, the pension promise will be paid using the accumulated assets at that time, and the pension promise will be paid as long as there are assets in the RCA arrangement.
All these costs, though, are these tax deductible to the corporation too?
Yes, they are.
Now, Sophie, we have to always strive for balanced conversation. So my last question is, if one decides to set up an RCA, what can go wrong with an RCA?
What could go wrong is only one bad thing, I would say, is that the CRA may question the RCA when pension formulas are excessive, not reasonable. Okay.
Mm-hmm.
And if this is the case, the worst case would be that the CRA declares the RCA as a salary deferral arrangement. That means that the RCA was not set up to pay a pension, but it was set up to just defer taxes on salaries. So the immediate consequence would be that the RCA assets will be taxable right away for the participant.
Okay. Sophie, that's, I think, a really good overview on the RCA. And one of the reasons I was excited to have you on the podcast is I love to meet new people. I especially love to meet new people outside of Ontario because I think that there's a lot to learn on finance, and I think that we have a lot to learn from one another. So again, I want to thank you for taking the time to join us today. It's been really nice to connect with you.
Yeah, thanks a lot for inviting me, and sorry for my big French accent, but
you did just fine.
This is what I am.
You did just fine. You did just fine, and I have to thank Marc Antoine for introducing us. But I know that he kind of went to you given your experience and your knowledge. So thanks again, Sophie.
Thank you.
All right, there it is, the RCA. Now, be honest, how many donuts did you eat during that episode? Because I can tell you, the first time I learned about the RCA, if I had hair left on my head, I would have pulled it out. I just wasn't getting it. But then I finally had my eureka moment. I was drawing numbers, making a little spreadsheet, and it just clicked. So let's recap it one more time. The RCA, the Retirement Compensation Arrangement, is a non-registered tax-deferred retirement savings plan. To be eligible, you have to be incorporated and you have to be paying yourself salary. Money put into the RCA is a tax deduction to the corporation. Money put into the RCA, half of that goes into the investment account. The other half goes into a refundable tax account, non-interest bearing, held by the CRA. It's a loan to the CRA. Money in the investment account can be invested pretty liberally. The only restrictions are really you can't loan it to yourself and you can invest it into some entity where you are at least 10% of the owner. Now, those two accounts, the investment account and the RTA, they have to be kept in balance. So interest payments, dividends, and realized capital gains, well, half of that's going to flow into the refundable tax account. And if you have investment losses, well, half of those losses are going to flow out of the refundable tax account into the investment account. Now, in retirement, you're going to be pulling money out of the investment account. And when you do that, you're going to be taxed at your marginal rate. And as you pull money out of the investment account, money is going to slowly flow from the refundable tax account back into the investment account as you pull it out. Now, understand that because you're only investing half your assets in the RCA, it is certainly a less tax efficient vehicle than the IPP. But remember, the contributions you're going to be making into the RCA are a full tax deduction to the corporation. So again, control what you can control. Keep in mind, there are going to be costs in setting up an RCA, but as opposed to an IPP, it's not mandatory to get an actuarial valuation every 3 years. Now, without a doubt, I think the most interesting feature of the RCA is if you are one of those individuals who is going to be moving to a lower tax jurisdiction. So, for example, if you're going to be moving to a tax haven where there is little to no tax, and if that place has a tax treaty with Canada, then you certainly have the potential to save a significant amount of tax because you would, in that case, likely only be charged withholding tax from Canada, which would equate to about 25%. So as opposed to paying the top marginal rate, you'd be paying 25%. That's a significant tax savings. But as always, don't enroll in this product for that possibility. You have to investigate it for yourself. And so, again, with an RCA, there's going to be an actuary involved. Your accountant is going to be involved. And if there is the possibility of moving somewhere else where the taxes are going to be different, there's going to be a tax expert involved as well. So just keep that in mind. And one last thing, I know a lot of us are DIY, so I did ask Sophie off the record, what's the potential for DIY investing in this case? So it turns out that a financial institution or one or more individuals can kind of be appointed to look after the investment. So it certainly does leave some room for DIY investing. But if you decide to consider an RCA, this is a question you may want to ask to clarify a little bit further. So guys, that's it for today. Retirement compensation arrangements. Again, as always, reach out. Fastest way to reach me is on LinkedIn or hit me up beyondmdpodcast@gmail.com. I love the feedback. I love the topic suggestions. So keep it coming. And until next time, stay well, stay savvy.